Now here we're going to look at, the summary of just what happened across, again, gasoline, kerosene or jet fuel, distillate, and resid, because we want to look at what are some of the movements that we've seen. And one of the things that we saw is we got that nice spike, again, for that the movements for Easter, spring break, but where the average never really got to a meaningful spot above that 15 million barrels a day. Instead, it continues to hang around this 2021, 2022 level when you look at the average. And even though gasoline has gotten, quote unquote, more normal, distillate and diesel has fallen down. And that's something that's going to continue to outweigh things because we still see gasoline demand staying about 10% below normal, while diesel comes under significant pressure. We've seen it from freight waves. We've been talking about it. We're going to use some other metrics to analyze it to show you kind of where some of the issues are. So when we look at the previous week, we were at 14.3 million barrels a day demand. This past week, we're at 14.08. So you can see how things are averaging out to be on the weaker side. But again, not like we're going to 13 million barrels a day. It's that, let's call it between 14.3 and 14.5. And we're going to have that steady increase. So to see an increase go to back to 8.6, 8.7 million barrels a day of gasoline demand is very normal for this time of year. And then again, it continues to grind higher, but we should be higher than that. And that's the problem when one of the pieces where we will go up, the demand will rise. It's just going to be, seasonally speaking, it's just going to be at a marked reduced rate. So now when we look at distillate, there was a small draw of 360,000 barrels. It's still very low in comparison at 14.8 million barrels a day, 14.8 million barrels below the 5-year average. But as you can see, the lion's share of it still remains in pad 1, and then the rest really in pad 2. Pad 3 had a bit of a build, and pad 3 is going to be the important one to watch as we see more of our exporting market regions start to get more competitive and start importing other products. And how is that going to shift things? And that's going to be the important one to watch as imports, again, fell 118,000 barrels a day, 70,000 below the 5-year. So getting back really to that, normal level, but it'll continue to kind of move a bit to the downside just because there's that additional product coming in. And maybe given the amount of space in pad 1 or the East Coast, this could be an opportune time to take advantage of some of those additional cargoes that are competing and coming into the Atlantic Basin, which will be a key piece here. Now, when you look at diesel cracks in the U.S., you can see they've come under some significant pressure. It's still on the higher end when you look through 2018 to 2021, but it's falling and we don't see much stopping it. So we do see more pressure to about $25. There you should start to see that level off a touch, but the slowdown on an economic level, the slowdown in shipping and trucking, continues to put that downward trend. And this is what refiners are relying on. And as you get a bit more of those exports capped, that's going to push more product back on back into storage, which again is going to push this crack spread down further. And as you have OSPs, the official selling prices remaining elevated, that's going to take that margin for some of these refiners. And you're going to start seeing some run cuts. And one of the key places that we continue to talk about seeing run cuts is Asia. And Asia is where we see, more pressure on crack spreads. Distillate in pad 1, as we were saying, still very much on the low end. There's more than enough space to go out there and source some of these additional cargoes, especially if they're priced right, given where we are. But again, we're at that low point, and we will start to see seasonal builds. The question is, what is the rate of change? Is it going to be aggressive builds, soft builds? And realistically, just given the lack of refining capacity in the area, without a big increase in imports, it's going to continue to remain on the low end, where pad 3 is going to be the one to watch. And here you can see that pad 3 storage started to tick up. And that this is going to be the area to keep hone in on when you look at exports and the issues of where U.S. Diesel exports and distillate exports are going to go, because demand remains low. And you could see that we didn't get this big drop. But again, some of that was unique to the time period, given where things are. So when you look at this realistically, one of the things that we've been saying at this point, we're going to stay to the downside. To on the low end, we will stay below the 5-year average. The things got a little bit cooler, so you got a little bit of a bump, or a nice little push, last minute push for heating oil. But then realistically, on that, once that drops off, you're going to see that disappear, and will continue to remain well below that 5-year average. Now, when we look at trucking, here you can see trucking is leveled off a bit at these reduced levels, but you're starting to see pressure here because tender rejections are broke 3%. So you're starting to see this come down even further. Again, there's just not enough stuff to move, and there's a lot of people to try to move it. So this is going to continue to be a pressure point overall. Now, when we look at rail traffic, you have carloads that were up 5.8%. And one of the things that we've been talking about is that we thought grains was going to spike, farm products was going to spike, and here we are. Motor vehicles, those key pieces continue to move. Same with petroleum, but intermodal units are still very low. And that's something that is going to be persistent when you look at that differentiating factor between where are intermodals and then where are the rest of the goods. And that is going to continue to be an overhang on the intermodal side, especially as retail sales continue to slow. Industrial activity is a bit reduced, and manufacturing. And a lot of this is, again, you can just look back to the cargoes coming to the U.S. and you can see that that's going to be a progressive thing that is going to remain. And here's just looking at, again, some of those key areas. When we look at these current months, these current weeks, you can see we're still below the previous week, still below the previous year. And that's going to continue to be the case. And then when we look further out, inbound containers at key California ports decline. Volume is back near levels recorded in March 2020. And now March was where we started to have some of those issues with COVID. So when you're getting back to those levels, you're actually seeing that diminishing period. And then when you go even further back, we're actually below where we were in 2019. And 2019 was not a good year when you look at trucking, shipping, and there was a lot of economic concern at that period. And those are the points we're back to, which is, again, not good for demand when you look at how demand is going to progress on the diesel distillate side going into those summer months. Now, here's a bit of that reprieve I was talking to. We got a little bit of a cold snap that came through, essentially from the Rockies Rockies east. It's fine during the day. At night you might have your heat kick on, but as we get towards the end of April, we'll see this diminish, and then May will have that nice little warm up and get something into the 70s instead of the upper 50s, mid 50s. So now when we pivot over to gasoline had a build of 1.3 million. That's still 15.1 million below the 5-year. Pad 3 had a build, Pad 1 had a build, Pad 2 had a draw. And when you look at what's driving the difference between over the 5-year, it's, again, Pad 1 and Pad 2 are well below. And that's going to be something to watch, and especially on the Pad 1 side, because a lot of this European product is stuck, and there's a significant amount of gasoline sitting in Europe, and it's a matter of when does that flow over. Gasoline imports dropped 113,000 barrels a day, 6,000 below the 5 years. So you're starting to see this level off, and now as it gets cheaper to move product, and we actually have a good chart in segment 3 looking at how the cost of moving product from Russia to India has diminished. It's as you get more ships available, you'll bring down the price of shipping, which will then increase the amount of imports from Europe into the U.S. Blending components only had a build of 0.15 of 150,000 barrels. So again, that's just indicative that we're still fairly flat. The build was probably a little bit too high. So we'll see that normalize a bit next week in terms of where some of these things are. But when you look at the data in general, we normally have the drop, then we start to see this flat line. And so the seasonal moves are normal, just at a reduced rate versus what has reduced levels versus what has happened in previous years, especially the last 5 years. The thing that's going to matter now is how are exports slowing? We see them slowing. That's going to put a bit more into storage. We do see some imports increasing into pad 1. That's going to bump things up a bit more. But there's room to absorb some of this, which is why we're going to attract it. And it's going to be the important piece to watch as we go over the next few weeks. Now, when we look at blending components, you can see that they're on the lower end, but still kind of flatlining, which is right at the average. The chem side still continues to be weak. That will start to see some of those builds and increases here. When we look at gasoline demand, you can see that the 2 weeks ago, they were Gas Buddy was at 8.58. This week, they're at 8.7. So again, you're starting to see that balancing out. And we think 8.6 to 8.7 is a very comfortable level to be. Could it be 8.75? Sure. But again, you're starting to see that kind of fit in to that normal level, just again at a reduced rate versus what has happened historically. And here's just looking at those historics. So we always have a dip for Easter. That is not abnormal. So you have to look at, and then obviously when you look at North America, you can see it happened a bit sooner, but we're bouncing back up. The question is, when we bounce back up, do we bounce back to where we were in 2019, or do we go back to that 90% of normal, or pre-COVID? And realistically, we're just going to go back to that 90% of normal. Same with Asia, obviously ex-China. Europe, some will likely go back to that 2019 levels, but those are the back and forth that we continue to see, and the pressure that we're seeing on general demand, and prices aren't helping. You had another increase in gasoline prices to now $3.68. This is national. So if you're looking at this and be like, Mark, I paid less just recently, it's like, yes, I'm not saying you didn't. On a national average, you're seeing that trend up, and on the diesel level, you're starting to see a flat line, and they're starting to meet. But you get an idea where, and as if you remember, we said that we thought things were going to kind of normalize out for diesel at 420, and here we are, right here. It's just as the little bit of cool weather kind of put a bit of a floor in it, but then as things warm back up, that'll continue to come back down and merge a bit and get closer to where gasoline is. But realistically, the issues are going to remain the same when you look at gasoline, because $3.68 is not an attractive price for someone that's struggling to figure out, can they travel, can they go away, and we always have an increase because it's more expensive to make summer blend versus winter blend. So it's not abnormal to see it, but it's when you look back through 2018, you can see it's at a high end, and that is going to be a problem when you look at people who have drained their savings or pulled down their savings, have increased credit card debt, are seeing their concerns about their wages, are expecting inflation to remain very elevated over the next year. That's going to put a pause in how much people spend, which is why when you look at gasoline demand overall, we're going to bounce back to 8.6, 8.7. And that's going to be very normal when you look at it. It'll be on the low end of normal, but it's all we're saying is we're not going back to pre-COVID levels. We're going to be at that 10%, 15% maybe, depending on the week, below what normally happens. But we will get an increase. Demand always increases into the summer. We're not saying we're not going to get it, because 8.6 and 8.7 as we get into June and July is going to go to 9.2, 9.3. We're not saying that we're going to stay at that sub 9 million level through summer. It's going to go to 9.2, 9.3, but we should be at 9.6, 9.8. And that's the difference. It's going to go up, just not to the same degree. And then as you have more pressure on U.S. exports, a bit more imports, that's going to put more into storage and, again, push down some of these crack spreads. And as crack spreads come under pressure, some of these guys are going to produce less. So, refiners will start to have some of those run cuts. Then you look at propane, had a draw of 720,000 barrels. But when you look at against the historical, very normal, and actually at the high end of normal. And that's why our prices are still competitive. We have great exports into the global market. That's not going to change. And that's where we're going to continue to see some of this move into the market. Jet had a build of 920,000 barrels, 1.1 million over the 5-year. And you can see when you look at jet, it's just on the lower end of normal. And that's something that's going to persist. So not too much there. And here, globally speaking, the number of passenger flights scheduled for the 12 weeks ahead is set to increase 11.1%. And again, that's summer travel. Not crazy to see that summer travel increasing. So there's really not too much to say one way or the other. When we look at U.S. checkpoints, here you can see that the Euro control area is 88.7% of normal, and the U.S. is 99.6% of normal. And as we've been saying in the U.S., passenger-wise, things are flat. They're the same as what they were. But the issue is there's just less flights moving people. So the evolution of global future scheduled flights. So when you look at March 22nd, March 29th, April 5th, April 12th, you can see how things have just reversed down a bit. As we were saying before, we had some of those cancellations in some of the bigger hubs. That just continues to be the case. So not too much has changed in general. When you look at flight passengers, as we've been saying, very normal, very stable. So not too much overall. Next week, we'll bring back the open table data. That was something that they had to repair something or just update it. So we'll have that back. But in the next segment, we're going to go deeper into OPEC flows, and how those things are shifting in general and what that's doing to the market as we head into May, as the market prepares for or looks for, what are things going to be when we identify or, what the size is going to look like from some of these cuts that were voluntary from the OPEC plus nations.